We need to talk about inflation a bit more closely. Unfortunately, it's a subject I don't like to bring up because it's, in my view, it's one of those philosophical subjects that economists like to talk about, and it doesn't really have a lot of effect in the markets until it actually does. So sometimes inflation can have an effect, and I think there's too much signals right now that there is a lot of inflation everywhere that I think we have to take this seriously and answer the fundamental question: is inflation going to impact the market substantially, or is it just a transitory phenomenon? This is a Not Even Wrong podcast. It's June 15th, 2021. This is Krim Delko. For the day, the fund is down 3%. The market is down 20%. For the year, we are down 12.9%. The market is up 12.9%. We're underperforming by 25.8%. The underperformance coming primarily from Tesla. And let's just jump right into the question. We have a lot of inflation in the market visible. When I say in the market, I mean in normal everyday life trading. Let's say you want to go on a vacation in the US, hotels are to the roof, flights are more expensive than they used to be, goods are relatively cheap still, but you see, let's say, price increases of Tesla, you see price increases of other durable goods, things like that. There's inflation. Now the question is this just a reopening of the economy? Is this just, it's going to take some time for supply chains to adjust, for people to show their real demand, for businesses to adjust? If you're a macroeconomist, you're going to think about this from a micro perspective and say, look, every business is going to be cautious because we don't know how much adjustment there is to expect in terms of demand. We don't know how much transitory versus fundamental structural demand changes there are. So we're going to be on the cautious side. And then when we have a demand surge like we have right now coming out of COVID, we have just more demand than supply. Prices go up. This is simply what's going on. You can see it in the hotel business. You can see it in the airline business. You can see it in cars. You can see it in many other areas of the economy. So that's one way to look at it. There is also the money printing. There's, of course, the argument we've been printing trillions of dollars. These dollars are now trickling down in the real economy the same way they've trickled down into the stock market. Now they're trickling out of the stock market into the real economy. People made money in the stock market. Now they want to spend some of that money. I just listened to a podcast yesterday. Excuse me, I'm sipping some coffee. So somebody spoke about NFTs and art and all that. And the person just, and this is a sort of an art tech person. So the lady that was talking on that podcast wasn't, by any means a fund manager. And she just simply, kind of in a nonchalant way, said, well, people made money on crypto, now they want to invest in NFTs. What she's saying here is much more fundamental than she thinks, because she's saying, look, I made money in the market, and if I'm not a professional money manager, I don't think in long-term compound rates. I just made some money, I want to go spend it. And that's what most people are actually doing. Most normal people that made money in the markets, they're not going to think, okay, this is my long-term return. And let's say Cathy Wood talks about the compound return, and if the markets are down, expect the compound return is higher. People don't think like that. People just see, I had $1 million in my account, now I have $3 million in my account. Well, I'm going to go spend some of that. And there's this fallacy that whatever you make in, let's say, crypto or the stock market, that's kind of funny money. But then you buy real estate or NFTs or stuff like that, which has implied scarcity, and that's real money because it's scarce. Now, this is psychology. I don't want to question that necessarily. Rich people have been doing this for centuries, if not millennia. They bought gold, they bought real estate in London, and so on and so forth. It's always the same game. I make some money in the funny game, which is the real economy, and then I park it in the scarcity game, which is London real estate or gold or NFTs. So this is how people are thinking. The reason I'm mentioning all these things is because there is just this desire to take some money off the table that was made in the financial market and invest it in, let's say, in the real economy, or buy goods, or buy an apartment. One of my neighbors said, look, I don't really want to own a place right now, but I couldn't resist because the opportunity is too great. Given all this money printing, real estate will go through the roof. So I bought a house, or I'm building a house somewhere in the southwest of the United States. So again, this is anecdotal evidence, but it piles up. Once you start listening to these comments, and then you have your own experience. Let's say we are traveling quite a bit right now for various reasons. There's sometimes it's easy, sometimes it's difficult. It's not across the board always very expensive, but nevertheless, there are signs of inflation. And again, I just want to mention this in a sense that this is an effect that we're seeing. We don't have clear answers of is it transitory or structural, but there is demand, and supply cannot match that demand. That is going on, I think, across the board, at least in the U.S. economy. What we're facing here as a family, as citizens of the Southwest United States. I don't know how it is in Asia. I don't know how it is in Europe. I'm going to Europe in a couple of weeks, so I have a bit more, a bit better idea what's going on there. But the question now, of course, is how is this going to trickle down to the markets? The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So we are actually running a hedge fund for the long term. The mission of Orange Capital Partners is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. This is our mission, and there's no word of inflation or anything like that in that mission. So we shouldn't necessarily waste too much time thinking about it, but we still do think about it because we have this, we are exposed to inflation. So if we had a scenario where there would be very high inflation, it would impact our companies, it would impact innovation, it would impact the pricing of assets, which of course is what we are exposed to as investors. Now long term, I think, just to calm down people that are in the same boat like us, long term you're fine. If you're in the innovation business, you really don't have to worry about inflation, because innovation will outpace inflation. But of course there is a point where that stops. Weimar Germany, things like that, political turmoil. Naval Ravikant recently said the path to inflation starts with money printing and then socializing wealth and things like that. I mean, what I'm trying to say here is there is a limit of how much detachment you can have as a real player in the economy when politicians and people and things like that around you go crazy. That's all I'm saying here. I don't want to make assumptions along those lines here, because I feel like we are, as a hedge fund, we kind of have to start assuming certain things as given. For example, the political environment, the social structure. We have to assume, is there a war or not? I mean, we cannot say, look, you're fine with innovation even during war times, because at some point, if somebody blows up a factory, no matter how much innovation there is, if people die, there's not going to be innovation. So we have to make certain assumptions about that. And what we're making, the assumptions we're making at Orange Capital Partners, is that we're going to function under the current political regime, which is a democracy in the United States, democracy in Europe, an opening up of China, wars along the lines that we had in the last few decades. We are not expecting black swans. We are not investing according to that. We also expect, now this is the key of this particular episode, we expect a certain stable fiscal environment. Stable means we have 2 to 3% inflation per year over the next 20, 30 years, and not more and not less. This is what we expect. This is our default assumption. It's not based on, it's not necessarily because we have technology that allows us to have more insight into this than others. This is not why we're doing this. The reason we're doing this is simply because we want to invest our focus and our resources into identifying innovation and engineering practices and new concepts. This is where we are playing, and not in the inflation game. So we're taking those things, inflation, monetary system, political system as a given, and then we're focusing on the real economy. This is how we operate. We could be wrong, but again, this is fine. We just have a certain limited amount of resources and time, and this is where we want to spend our time and our resources. So back to the question now, given all this, given the question, given the fact that we are not too overly concerned about inflation, we still have to ask the question, because no matter what, there is a potential for a derailing of the financial system. There is this potential, and what we're seeing right now in the real markets is concerning. And the question is this going to derail the financial system? Now, there are 3 points I want to mention. First, I think there's a very high likelihood that this is transitory, because the supply chains need to adjust. Your local restaurant just hasn't been operating for 12 months. The owner has to rehire people, has to go order stuff. The people will be a little bit more expensive because they're reluctant to work because they have unemployment benefits. So there's a lot of that kind of stuff going on. It will pan out. It will fall into some sort of natural equilibrium. This will not continue forever. So this is number one. Number two, we have a massive monetary influx into the economy, which has been going into growth stocks and now is trickling down into everything else. I think that's also there to stay. I think this is the biggest concern we have on the macro side for the US and the rest of the Western world, that the money printing has been considered as sort of a normal thing, and that we have this culture now of just giving money to people and that they don't have to work and still make a living. That is a risk, and this is probably the biggest source of inflation that we can see right now. Again, this is something that I think is a lot more complicated than we can discuss in just a short period of time. And I would like to say also this will pan out in sort of an equilibrium, maybe, but I don't think so. I don't think it will. I think you will have a deterioration of government institution in the United States. We can see that already, particularly in liberal states like California, where schools, police, all these things are deteriorating because partly people just are used to working less and also are using COVID now as a reason for many things, but in particular not to work, like SFUSD, for example, our school district hasn't been open since February of last year, and the reason is COVID, but of course there are other reasons, political reasons, why kids haven't been going to school, and that is just not okay, and that is creating huge inflationary pressure. So this is a concern that we have, and we quite frankly don't have an answer for how this will pan out. The only hope is that through innovation and growth and all these good things, hopefully that cancer that is spreading throughout the economy, so that cancer of government institution deteriorating, can be at least derailed for a while. And third, and I think this is the most important thing, and we get back to the point of actually innovation. So what is going on the innovation front? I think let's remind ourselves why we're in this. We have some of the biggest inventions, some of the biggest breakthroughs in science and technology ever that we have. For example, artificial intelligence, machine learning, huge potential on computer vision and self-driving cars. We have the CRISPR revolution, the genomic revolution. Those are massive changes in the way we do things, in the way we instantiate knowledge and technology into products and services. We have blockchain technology, which is decentralized way of decision making that is going to spread across every aspect of the economy, finance, politics, law. Again, massive improvements. So when I say improvements, it is accelerating efficiency. You can do a lot more for less cost, and you have to pay a lot less middleman and things like that, and that is going to drive inflation down. So we have this third aspect, the innovation aspect, which in our view is going to drive inflation down, and we have the deterioration of government institution, which is going to drive inflation up. And then we have the first aspect I mentioned, which is simply the sort of the transitory readjustment of supply chains, which we think is transitory, so therefore not that important. So to conclude this episode, we believe that at least for now, we see that innovation, the three big variables of innovation, artificial intelligence, CRISPR, and blockchain technology are strong enough to keep inflation in check, and that the biggest factor which is driving inflation up, which is the deterioration of government institutions in the US and other Western countries, that will not be able to hurt the financial markets enough for us to be concerned. At least for the next 5 to 10 years, these things can change. And again, we're not predicting any black swans here. We are not in the business of doing that. We don't hedge for that. So this is simply also because we don't think we can. But it's just not our business. So let's leave it at that. And therefore, we're very confident that with Orange Capital Partners in our portfolio, we can continue delivering the very high compound returns that we strive to deliver through our mission. Thank you.